Stock dividend. A stock dividend is a payment of sharehold that consists of additional shares rather than cash. The distribution are paid in a fraction per existing share. For example, if a company issue a stock dividend of 5%, it will pay 0.05 share of every share owned by a shareholder. The owner of 100 share would get a 5 individual share. Stock individual Stock dividends are not taxed until the shares are sold by their owner. Like a stock splits, stock dividends dilute the share price because the additional shares have been issued. Stock dividends do not affect the value of the company. A company may prefer to pay dividends in the stock rather than the cash in order to preserve its cash reserves. So, what is a dividend and how stock dividend works? So, stock dividend may be paid out when a company wants to reward its investor but either doesn't have this spare cash or prefer to preserve it for other uses. The stock dividend has the advantage of rewarding the shareholder without reducing the company cash balance, but it does not increase its liability. Stock dividend has a tax advantage for the investor as well as like any stock dividend are not taxed until the investor sells their shares. A stock dividend may require that the new received share not be sold for a certain period. This holding period on a stock dividend typically begins the day after it is received. Stock dividend dilution. Stock dividend acts to dilute the company existing shares. This means that adding share with the no corresponding increase in the capital works to reduce the values of all the firm shares. For instance, uh, image the board of a public company approves 5% of stock dividend that give existing investors of one additional share of a company stock for every 20 shares they currently own. So they said that the company shares had a market of value of 2.50 dollar and one investor owned 20 shares before the stock dividend. The investor would have $45 worth of share, but when they receive one or more share from the company, they would now own 21 share with the value of $45. Each share would now worth 2.14 dollar. In this way, a stock dividend is similar to a stock split. So, what are the advantages and disadvantages of stock dividends? From any investor viewpoint, there is little immediate reward in receiving a stock dividend. Then again, there is no tax due to until the additional share are sold. Issuing share dividend lower the price of the stocks at least in the term of short term. A lower practice stock tends to attract the more buyers, so current shareholders are likely to get their reward down the road, or they can sell the additional shares immediately, pocket the cash, and still return the same number of cash they had before. A public company is not required to issue dividend at all. However, it is not a good look for a company to abruptly stop paying dividend or pay a lower dividend than it has in the past. For a company, a stock dividend is a pain-free way to issue dividend without depleting its cash reserve. A small stock dividend accounting. A stock dividend is considered small if the share issues are less than 25% of a total value of a share outstanding before the dividing. A journal entry of a small stock dividends transfer the market value of the issue share for return earning to paid in capital. Company X declares as 10% of stock dividend into 500,000 shares of a common stock. It's a common stock has a par value of $1 per share and a market price of $5 per share. When a small stock dividend is declared, the market price of 5% share is used to assign the value of dividend as 20 to 25 to 50,000. The common stock dividend distributable is $50,000 since the common stock has a par value of $1 per share.